All right, thank you for joining us for this September 2024 update for the Impact Lending Fund. We have officially passed our 6-month anniversary with the fund, so we wanted to get together as a group and share some of the learnings, share some of the results, and share why we continue to be so very excited about this offering for our investors. So we'll go ahead and jump in here real quick. Of course, today what I will be covering is I'm going to talk a little bit about the return structure and investor benefits. I'm also going to dig into, why would we choose to work with a lending fund and a debt fund, and why this could make sense for you, as well as why now does this make sense to be leveraging this type of tool in your investing. Then I'm going to hand it off to Justin, and Justin's going to walk through some unique investing options and benefits that we have for this specific fund. So Justin will dig into those in great detail. Finally, Tommy's going to talk about how we are getting the returns that we're getting on this and with whom we are partnering. I'm really excited to provide some updates on our fantastic partner that we have in DLP Capital. And then finally, Tim will jump in and provide a great overview and closing commentary before we hand it over to you guys for questions. So let's go ahead and jump into the material here. But first, we need to have a quick word from our attorney. This is a standard disclaimer you see at the beginning of all of these, but essentially what it's saying is we are not attorneys, we are not accountants, we are not CPAs, and we are definitely not investment advisors. What we are sharing is our experience and our understanding of this space. So please consult with your trusted advisors and professionals to give you any tax and legal and accounting advice. This will be shared so you can really dig into that fund rating at some point. But for now, let's jump into the material. Okay, so what is the Impact Lending Fund? So the Impact Lending Fund, it is a short-term private lending fund. So this is essentially a fund that is built to fund short-term projects in the real estate space. So the operator has been in place for 10 years, and we'll talk more and more about the track record here, and that's really, really important to hone in on that. But essentially, what he does is he lends to other operators that are just like him, people in the fix and flip place, value-add multifamily folks, developers. It is short-term debt. These are not 5, 7, 10-year agency loans. This is generally about a year loan. And this is a lending fund that we use to raise dollars from retail investors like ourselves and you for this fund to then lend out to that avatar. So it is a short-term lending fund. It is highly diversified. So this is not a fund that's going to lend to one operator or even one asset class or even one geography. There is tremendous diversification across many, many different operators that are hand-selected by DLP Capital, our partner, and they are only in markets where DLP has a very strong presence. They are only with operators that they've got a long-standing track record with, and there are multiple loans with many of the operators they work with. So great diversification across asset classes, great diversification across business models, great diversification across deals as a whole. The debt that we are doing for this fund to these operators is a first position lien. So as you all know, in any type of real estate loan, there is always a first position, potentially a second. We're going to actually go through the different assets or different levels of debt that are usually involved in real estate. And essentially what that first position lien means is we get the first dollars when those dollars come to pay back. So any dollars that get paid, we get paid first, and then all of the other creditors get paid. And then finally, this fund is backed by a 10-year track record where they have met or exceeded their targets. They have never lost $1 of principal. They've never lost $1 of interest. And 10 years, they have consistently paid monthly distributions at or above targets. So you don't you don't get those type of results by mistake. And that is why we love partnering with DLP. So let's jump into kind of the structure of this and some of the benefits. And I'll move my face here so you can see it. But the general structure that you can expect is about an 8 to 9% return. We've seen around an 8.25% return in the first 6 months of our fund. But historically, we have seen these targets being hit for the entire 10 years, not dropping below what would be the 8% return model. So while we cannot guarantee future returns to be that, because past returns don't guarantee future success, but with a 10-year track record, we feel very comfortable with that. You'll notice that we've got a $25,000 minimum on our investments, and it's really, really important to us that we continue to make these investments available at a $25,000 investment to our investors so they can get not only diversification within our offerings, but diversification across multiple asset classes, multiple operators, multiple investments. So our advice, as always, is to diversify. Of course, we would love you to invest in all of our deals, but we understand you need to diversify across others, and having a $25,000 minimum allows you to do that. Something that's unique about this specific structure is we do not have a lockup period. So you literally could invest 1 month and pull the money out the next month if you wanted to. While we don't encourage you to do that because we do have fees that really, you need to have the dollars in this fund for at least 45 days for the math to work on it. But we're not like many of the other funds that will require you to keep those funds in place for a year, sometimes 2 to 3. I've even seen 4 to 5 year lockup periods, even longer. So literally you have control of your funds, and you're going to be getting monthly distributions throughout that entire period. So really, really important pieces on, and things we're really proud of to be able to offer in this structure. So the benefits, and something unique to ours, is we allow our investors to choose whether they want to take monthly distributions for cash flow, or do they want to compound their returns. There's a lot of groups that require one or the other, but this is a really, really great option if you're investing with your self-directed IRA and you just want those compounding returns to grow. Or if you're in a position where you need livable income, the cash flow that's generated from this on a monthly basis is fantastic, and great livable income for you to count on and depend on. This is the least risky of offerings that I have, not only in our offerings through my organization, but also in my own invested dollars in private real estate. So very, very low risk because of the no lockup period. And on the lower right-hand corner, the biggest reason is why this is a very, very liquid investment. So you have the option of asking for your dollars back and getting those dollars back quickly, whereas traditional syndications generally have those locked up for 3 to 5 to 10 years. Again, you can make a request for a redemption on this, and we have the ability to get those dollars back to you very, very quickly. And if you want to know details more specifically about that, please check with the person that you're working with through the Impact Lending Fund, and they will give you the then current time frame. But it's less than 90 days and probably no more than a couple of weeks is what we probably suspect that this is going to be. Okay, let's jump into why use a private lending fund as part of your diversification strategy with your investments. And there's a number of different reasons. We have 7 here that I'll get into. And we think that these are some of the most important. So first and foremost, these are extremely low risk, going back to the structure of first position liens, diversified across a very large number of different loans. And we've not seen any losses in this fund for the last 10 years. So these are number one in the capital stack. You're going to get your dollars back, and they come back quickly. So returns are significantly higher in this than other competing short-term offerings that might be in place. We hear a lot of people talk about high yield savings accounts. We hear a lot of people talking about CDs. We hear a lot of people that are seeing 3, 4, 5% in any number of different tools. And this offering will give you almost twice as much as any one of those offerings with almost the same liquidity and I would argue with a very similar risk profile as well. Another area here that's really important and why this makes a lot of sense is these are not correlated and don't go up and down with the stock market like so many other alternative offerings do. This is not tied to the stock market. You're not going to see when the stock market goes up that this is going to go up, and when it goes down, this won't go down. This is solely based on the lending environment and what rates we can get for loans. So really, really important if you're a REIT, or you're trying to put dollars into the market, this is going to be something that will not change with consumer sentiment or any of the wild changes that go on in the S&P. We've talked about diversification a lot. I won't talk about that a whole lot more, but it's important to know that there are literally hundreds of loans that these dollars are going into. So you're diversified across many, many different sizes and types of loan, and we'll get into those details in a little bit. I really like the stability in this specific offering that we have. When we share later in the presentation, you'll see the fluctuations in the returns month by month over the last 5 or 6 years. And we can actually break that out into 10 years so you can see the highs and lows in this fund. What it does is it creates predictable income for you and predictable returns that you can count on as needed for you to make decisions in your investing and in your life. And then lastly, track record. We're going to spend a lot of time talking about track record because, as you know, in any type of investment, you're betting on the jockey. And we feel we have picked the very best jockey in the space, who's got an amazing track record, long beyond the 10-year track record of this loan. It actually goes back to almost 20 years that Don Winter and the team at DLP Capital have been performing at a very, very high level. Okay, and I think just through these different items, it's really easy to see why private lending can make a lot of sense. But I wanted to dig in and talk about, like, does private lending make sense today? And our argument is that we think now is the best time to investing in this space because of some of the very unique things that are going on. And if you're investing in syndications or if you're investing in other real estate, I think a lot of these items are going to resonate with you. So we've heard for the last couple of years have been very, very tough in the banking industry. Banks are forever under pressure to bring in additional deposits, and in fact, they're actually losing deposits. And as banks lose deposit, that decreases their ability to lend because the amount of dollars they need to keep in reserve to cover those loans is decreasing significantly, actually putting more of a need and more of a demand for private lending. Okay, we've all heard this huge tidal wave of debt that will be maturing in the next year, 2, and 3 years. So over the last handful of years, we've had a number of loans that have actually been done, and those debts are coming due now. And with interest rates where they are today, it's creating a situation where operators are not being able to refinance those loans as easily as they could have in the past. So the banks have exposure on loans where the loan balances quite often are actually higher than the value of these assets. So once again, it's creating more demand for private lending because traditional banks are not going to be able to come in and save the day here. We've seen a lot of increases in expenses since COVID. Cost of insurance has gone up, cost of taxes have gone up. All of the costs associated with operating these specific assets have improved significantly. So while we're not seeing a lot of distress on the asset levels yet, we are seeing owners in a distressed situation. Their loans are coming due. They're facing potential loss of investor capital for their specific investors. And again, it's going to put or create a great opportunity, a great demand for private lending, which all of these things come together to really create a great opportunity for this specific fund. And then lastly, it's really, really important to talk about the returns to our investors here. So in this high interest rate market, investors are looking for great returns and they're not finding them in other areas. So that just creates one more reason why private lending is such a great option today. So with all of that said, we want to jump in now and talk about some of the very special and specific characteristics of this offering. And I'll go ahead and hand it over to Justin to take it from here.
All right, Randy, thanks so much. My name is Justin. I'm going to be talking about the advantages of debt funds, specifically our debt fund, and why we love aligning ourselves with the Impact Lending Fund and our partnership with DLP. So first thing is we have the ability to compound or pay out a simple interest. Now, this is something that is very unique to our debt fund because it is very, very labor intensive and accounting intensive to be able to offer both a compounding option and a paid out every single month option. So if you are looking for consistent payouts every single month, we have an option for you. If you want to compound where you don't really need those payouts right now, but you want to be in a highly liquid fund that is all the way on the bottom of the risk spectrum of real estate investing, you still want the benefits of having that cash flow heavy investment, but you don't quite need those payments now, you can utilize our compounding option, which just allows you to build on top of your initial equity. So that's one thing that we're super, super excited about. The next thing I want to talk about the capital stack and our risk versus rewards. So if you are experienced in the alternative investing space, or you've invested in other syndications and apartment buildings or anything like that, you're probably familiar with common equity. That's how a lot of investments are made. Now, common equities up here at the top, it has the highest potential payout because the capital there sits in the riskiest spot in what we call the capital stack. What this essentially means is if the deal misses projections or goes completely sideways and there's not enough profits to pay back all of the investments, common equity is the last in line to get paid. So it's in the riskiest spot. And because of that, you have the highest return potentials. Your return potential is typically uncapped because most of these are made in equities, investments in equity. So you have the potential for really, really high payouts. Just below that, preferred equity will get paid out before common equity. Now, again, as we go down this spectrum of risk and reward, we typically see lower potential returns. You might have seen preferred equity in some other investment decks. A lot of times they'll offer you a fixed payment, maybe 10% is pretty common what I see right now. To have a lower position in the capital stack, have a safer spot for your capital, but you sacrifice a bit of return that common equity might see. And then the bottom two are investments in debt. And it's a very, very specific difference in a mezzanine debt fund and a senior debt fund. Now, some people might look at our debt fund and you might ask, why are your returns much lower than other debt funds that I've seen? And that's because those debt funds are investments in mezzanine debt. These are second position loans. They are secondary after the senior debt, and they are in a riskier position in the capital stack. And because of that, they deserve to have higher interest payments for them. So anybody who takes out loans on properties, your senior debt's going to have the cheapest interest rate. Your mezzanine debt is always going to have a higher interest rate. That's why those return projections are higher. I've seen as high as 12 to 14% for mezzanine debt funds, just depending on the type of risk profiles that they're investing in. Our debt fund is here in the senior debt portion. What this means is we have the first position loan on the property. Our capital is the safest position and the first to get paid. Even if a property falls under projections or expectations, the senior debt gets paid first and has the absolute highest priority. It's one of the reasons why, since inception in 2014, the fund has not seen a lost capital event and the fund has not underperformed or missed a monthly distribution. It's because our investment is in the safest position in the capital stack, and we do sacrifice a bit of yield potential because of it. But we feel that when you invest in debt, we want to invest in the safest position in debt and get our payments back first and have that highest priority. So if you see a lot of other debt funds out there, they're projecting higher returns almost every single time. They are mezzanine debt or private credit debt, which is pretty much the same as mezzanine, and they're in a riskier position. Those are the types of investments that we did not want to be in. We want to be in senior debt only, as the highest payback potential and the lowest risk anywhere else on the capital stack. Also, how we diversify in this fund is really, really important to us. One of the reasons why we like this fund so much is it's diversified across over $1 billion in loans and 35 states. in multiple different asset classes. So some new development, some existing product, single family, commercial, residential. It has a little bit of everything. And we ultimately want to copy the ultra wealthy. So when we look at investment distribution from Tiger 21, their member allocation, we see it growing in real estate and we see it growing in fixed income. This fund would be classified as fixed income backed by real estate. So we get to diversify a little bit in both of those. The diversification of this fund is unlike any other fund that we've seen. Again, 35 states and growing, all sorts of asset classes, and all sorts of development positions as well. So it's as diversified as you can get. The lowest risk positioning, going back to the capital stack, we want to be the bottom of that capital stack. We want to get paid back first. So we have the lowest position risk. And monthly cash flow distributions. Again, you can take them as simple interest or in a compounding nature, but cash flow that happens immediately and consistently every single month without a missed or underperformed distribution since the fund was created. So DLP Capital are our partners on this one, and we're super excited with the operations that they have there. I'm going to talk a little bit about their leadership team and then introduce you to our team and then hand us off to dive in deeper into DLP's operations. So Don Wenner is the founder of DLP Capital, and he has a massive accolades in the real estate game. Over 30,000 transactions he's been a part of, over 10 billion in real estate. It's funded over $5 billion in loans, with just over $1 billion of those still active right now. Wall Street Journal bestselling author, 18 years founding DLP Capital. Really, really smart guy, somebody who you want to align with and knows lending, knows banking, knows real estate at such a deep and intimate level. It's also surrounded by a great leadership team. So one thing when you invest in our fund is you're not investing in a private money lender or just somebody who lends out two flips. You're investing with a big operation with a strong leadership team who has been there and done that in the real estate game, formal acquisitions teams, formal investment directors. We align ourselves with some of the best in the industry to be able to mitigate risk and deliver a superior product. And now for a quick introduction on your fund management team, we have Randy Smith. Now, Randy is a 25-year corporate America sales and sales leadership professional that transitioned to full-time into multifamily investing in 2022. He's helped over 100 investors place over $8 million into passive investments in multifamily syndications. Then we have Tommy. Tommy is a former electrical engineer and data scientist that's transitioned into real estate investing full-time. He's incredibly detail-oriented and plays a pivotal role in overseeing fund accounting and operations. And Tim is a neuroscientist and multifamily investor, owner, and operator. And then you have me, Justin. I've been in the real estate game since I was 18 years old, and now I'm in full-time helping others invest passively into incredible multifamily opportunities and funds like this one. Now I'm going to hand it off to Tommy to really dive into the nitty-gritty of DLP and their operations.
Hello, hello, and thank you, Justin, for talking about the fund's unique investor advantages, as well as introducing the full team for this offering. So my name is Tommy Brandt. I'm a managing partner of the Impact Lending Fund. I'm excited to share with you guys today that we're going to be talking about the fund operations. So what is the profitable business that's generating return for investors, the fund structure, the risk mitigation, and also the track record and performance. And so if I can direct your attention to the left side of the presentation, first and foremost, DLP, who is our lending partner for this, they are a multifamily real estate operator first. So that means they have 40,000 units, they have 5 billion in assets under management, and they're also vertically integrated. Right? So they've had 18 years of asset operations experience. And what vertically integrated means is not only are they buying existing assets, they have property management to help them self-manage. They have a construction company to help them with value add or new construction. And they also lend to other multifamily operators that are doing the same. And so they've been lending for 10 years. So inception was October of 2014. And so that's pretty exciting. There's been a lot that's happened since that time, and they have demonstrated excellence the entirety of that time and never missed a single single distribution to investors. Since they are an operator and a lender, they're only going to be lending on assets in markets, on business plans, on assets where they have deep-seated expertise. And forgive me for not putting it on the slide here, but they've issued over $5 billion in loans since inception 10 years ago. They're in notable markets throughout the US. We'll actually show a map of it a little bit later. But these loans, the lending to other operators, these are first position loans collateralized by real estate. They're not selling off the notes or anything like that. And so they're holding on to the loans. They're enjoying the interest payments, and they are very picky about who they lend to. And so on an upcoming slide, we'll make reference to their average borrower, what a typical borrower looks like. And I'm hoping you'll be as impressed as I was. So the mission within DLP is to help provide attainable, affordable, high density housing while being community driven. Okay, now we're going to talk about what are the risks in a business like this, and then what are we doing to mitigate those risks. Okay. And we'll just go through these. I do want to emphasize most of my time here on this slide on the operating risk, probably for obvious reasons, but I'll still go through these other ones here. So let's touch on interest rate risk, right? So there is interest rate risk because they rarely stay in one place at any given time. They're always going up or going down, depending on what the Fed chooses to do with that one. And so how we counteract the risk associated with interest rates is we have short-term loans. So typically these loans are anywhere from 12 to 24 months. I think their average is around 18 months. And so we're able to adjust our product with what's going on in the financial markets. Next, we got the market risk. And so that is probably more obvious in terms of real estate market, right? Everything is location, location, location. So we wouldn't want to extend a loan to someone in a market where DLP does not have presence, or they don't have expertise in that market. And so what you'll find is that whenever we share the geographic snapshot of where they're issuing loans, it aligns very heavily with where they have a portfolio. Moving on to the credit risk, right? In any sort of lending business, this is always going to be a prevalent risk. So just know that DLP has strict criteria for operators, as well as the assets and the business plans that they're underwriting, to ensure that this is a low risk investment for the lender's perspective. And so moving on, there's going to be the liquidity risk, right? In the event that an investor wants to redeem their investment offering or investment portion, there needs to be some liquidity within the fund to be able to accommodate that 30 to 90-day redemption period. And so on any given, this kind of goes back to my comment on the short-term loans. And at any given point, about 20 to 25% of their portfolio is maturing on a quarterly basis, right? And so because we have these short-term loans, they're coming up, as the maturity dates are coming up, there is kind of that ongoing liquidity coming in and coming out of the lending business. Now we get to the operations risk. This is a bit of a mic drop moment, and it's probably obvious, right? The longer that you've operated, the more that you're mitigating your risk, because you've navigated high interest rate environments, low interest rate environments, and still been profitable along the way. So when I say 10 years, it's probably a mic drop moment. My mic is stapled to my desk, so I can't drop it, unfortunately, but this is a big deal. And I'll talk about why in a little bit, but I'm having confidence that they're going to be able to navigate whatever is going on in the future, given their experience. We talked about them being an operator and a lender, right? That greatly reduces our operating risk, and which gets into the discussion topic around default risk in a lending business, right? What happens if a borrower, stops making their payments, and becomes a liability, and has to sell the fund, right? In the event of a default, the fund operator has two options, right? So the first option is the traditional method, where we can start the foreclosure process. We can try to auction the property or wholesale the property or sell the property, probably going to sell at a loss, and those losses would get exposed to investors that are in the fund, right? Option two is if your lender is also an operator. In the event of a default, the operator that has market expertise, asset expertise, and business plan expertise can effectively take over the note at face value and just pick up where the previous group left off with their business plan and the market and the team. And so that inherently protects investors from losses that otherwise would be exposed to the fund. So it's important for the lender to also be an operator in private equity real estate lending. So The last thing I want to touch on has to do more so with kind of the dynamic of the marketplace for private lending funds or debt funds in general. There's been a lot of new funds that have started over the past 12 or 18 months. They don't have geographic diversification, or they don't have operator diversification across a couple different operators. And they just they don't have experience, honestly. And so I would just in full transparency, a high interest rate environment is the best time to start a private lending business. It's the most forgiving. And so just know that there's some folks that have started a private lending business that I don't know if they're going to be demonstrated excellence the entirety of the time. So I kind of heed a little bit of caution with newer operators in the space, which is why we partnered with someone that's demonstrated excellence for 10 years. All right, now I'm going to talk a little bit about the fund structure. So at a high level, I know there's a lot of numbers on here. At a high level, we are giving 8 to 9% returns net to investors, net of all the fees, et cetera. Our distributions are going to be monthly, so they're pretty predictable, very stable income sources. There's no lockup period. So typically we find that in the marketplace, there's 12 to 24 months lockup period for most lending funds. So we have no lockup period. So in theory, you could invest today and then tomorrow request to start the redemption process to get your money back. A lot of places you will incur several fees if you try to do the same thing. But because this fund is so mature and it is so liquid, there is no lockup period on this fund. So pretty cool. The minimum investment for this one, we actually have a really low minimum, probably for just the first year before we start increasing it, is $25,000, right? And so most alternative funds out there, or, our competition in the space, they're charging 4 times that. So you're seeing a lot of 100K minimums across the board. You're seeing a lot of 12-month lockup periods. And that's 2 ways that we really differentiate ourselves from each other. So in the 10 years that this fund has been operating, there have been 0 missed distributions. Maybe that's worth repeating again. I won't do it, but that's a big deal, right? That's over 100 distributions. None of them have ever been late, which is fantastic. So as far as our fee structure go, we do have a 1% fee on initial capital placed, and then we also do our profit share on the back end. So 85 to investors, 15 profit share to the fund managers there. And so, on the topic of fees, we did a ton of research with other funds before we started ours. And there's acquisition fees, there's monitoring fees, there's redemption fees, there's asset management fees, due diligence fees, there's early exit fees, right? And the list goes on and on. And so we didn't want to overcomplicate things. We wanted to keep it simple. Our only fee, it's really only the initial placement fee, right? And that's effectively our cost of due diligence for finding a partner that we think is suitable for our investors. And when it comes to the profit share model, our options were to either do an asset management fee or share in the profits with investors. And so, with an asset management fee, the fund managers are getting paid regardless of how the fund performs. But with a profit share, I think that shows more alignment with the investors, because if the fund does well, then everyone benefits from it. So that's a little bit of the thinking about why we chose the fund structure the way that we did. Okay, and as far as how to evaluate a fund, the LTV average and the LTC average are probably going to be the best metrics here. I put more emphasis on the LTC because the LTV can theoretically be subjective. So the LTC, what I typically like to see is a loan to cost average of under 60% across a portfolio, and they are doing just that. So, okay, and I'm not going to spend a lot of time on this slide in particular, but this is the geographic snapshot in which you can see what loans per areas are approved. And so you can kind of see that they have a presence in the Northeast, the Southeast, and the Midwest, and then some select markets otherwise. And so I think what you'll find is if you overlaid this with their $5 billion portfolio, that a lot of these markets align with where they're operating as well. All right, and now I just want to give you a snapshot of some of the loans, their performance, what are the regions, what are they lending on, and what markets are they lending in. And so there's a lot going on here, but this is an example of what you would expect to get on a monthly report on a monthly basis. This is our part of our transparent reporting that we pass to investors. And so you can kind of see, because they are a multifamily operator, that they are lending largely on multifamily assets or land to build multifamily assets. So you can see the asset classes that they're lending on, the markets as well. So you can see they're heavily exposed to Texas and Florida. I think what you'll find is that wherever the population growth patterns and migration patterns are, that's where they want to be. Okay. And as far as the loan performance goes, you can kind of see they're extremely low levels of delinquency for their loans. And so there are some predatory lenders out there that love foreclosing on people. DLP is as a group that they're here to just help people out and lift other people up, which is a big reason that we decided to work with them. So the fun thing to point out on this one is their typical borrower. It's really phenomenal. So the average liquidity of their typical borrower has $4 million in liquidity. Their average credit score is low to mid 700s. You can see they've done several projects, very experienced operators that they're lending to. And you can kind of see, because the average number of loans that they have per borrower is more than one, you can kind of see that they love repeat investors. They're emphasizing relationships, and they want to keep working with good people that are on a great growth trajectory. All right, and here I'm showing a little bit of the most recent track record, and I keep talking about track record. This is a snapshot of the past 5 years of performance, so you can kind of see where the fund has been. There's some fluctuations for sure, but we've never been below our target of netting to investors between 8 and 9%. And I say 5 years, but think about what's happened in the past 5 years. There's been high interest rate environments. There's been incredibly low interest rate environments, but we've still been profitable and within range of the target returns we have to investors. So very, very cool stuff. I think if you asked for this for most funds, they wouldn't be able to go back further than 2 years. So I'll say it again: track record, and more track record. All right, and as we wrap up my section of the presentation, I just want to recap a couple high-level metrics of where the fund stands today. So you can kind of see that there is over 1 billion with a B of loans that are currently active today that they manage. And because they've been doing this and operating this for excellence for 10 years since inception, again, sorry, it's not on the slide here, but since inception, they've issued over $5 billion in loans. So that kind of gives you an idea of their growth trajectory that they've been on. It's been fantastic. All right, everyone, that's it for me and my overview of the fund operations. Hopefully you learned something new, and hopefully you enjoyed learning a little bit about how the sauce was made. All right, now I'm going to pass the mic to Tim. Stick around, because he's going to be addressing the burning questions that you have. And if you've watched this far, you're going to want to hear what he's got to say. Thanks.
Thank you, Tommy. This is Tim Fergestad with Oak Street Assets. If you're interested in investing in the Impact Lending Fund, we'd love to have you. There are some investing requirements. First of all, we accept cash or retirement funds, such as self-directed IRAs or solo 401ks. If you have any questions about that, please reach out and ask us. We work with a number of custodians, and they're happy to help. The minimum investment is $25,000, and this offering is only available to accredited investors. There are two common criteria people use to qualify for accredited status. That's either net worth or income. You have to generate $200,000 a year income, or $300,000, including your spousal income, to qualify, or have a net worth of $1 million or more, excluding the value of your primary residence. The next slide here shows a sample $100,000 investment over a 5-year period with an 8% return. You can see that our simple investment option is you would get $8,000 of distributions each year from that $100,000 investment, distributed monthly, by the way. We also offer a compounded option, in which case, instead of distributing the $8,000 to you spread out over the year, those get reinvested into your investment and increase the principal, in which case your investment grows quicker. You can see that after a 5-year period, you have almost $9,000 greater return, and an average annual return closer to 10%. That's a great option for people who don't want the cash flow and want to grow their investment quicker, and possibly using retirement funds. What makes us different? Well, first of all, at Impact Lending Fund, we have a very low minimum entry. That's $25,000 to start investing in this fund. There's no lockup period. This is arguably the most attractive aspect to this fund. That's the liquidity. Other debt funds often have a 12-month or more commitment for your capital account. Our investment is more like a high yield savings account. You can get your money back without the lockup period. There's also a lot of diversification in this fund. Like Tommy said, they have over $1 billion in assets under management in this fund and have been running it for over 10 years, giving consistent returns the whole time. But also it allows them to invest in different projects in different geographical markets and different asset classes. All of these aspects create a great option for placing capital, particularly if you don't have a use for it at the time, you're waiting for a bigger project, or you don't have enough for the minimum investments, like $100,000 we normally have in our opportunities. This is a great place to put it instead of a high yield savings account, for example, because you get almost double the return. And by the way, the Fed has started lowering rates, which will likely lower savings account interest rates. This return, again, has not changed in over 10 years. All of these aspects make the impact lending fund a great place to put capital, whether it's for the short term or long term. Here are some frequently asked questions. You can pause the video here and look at these in detail if you like. I also recommend you go onto the investment portal and look at the private placement memorandum or investment documents, the PPM. If you have any questions on anything, please reach out to Randy, Tommy, Justin, or myself. We'll be more than happy to help you with anything. The next steps are to go onto the investor portal. If you're an existing client, you'll find a new offering in there. You can just click on it and get the documents and sign up that way. If you are new, then you have to go onto the investor portal and create an account, and then click on the Invest Now in this opportunity to get access to the details, including the private placement memorandum, in which case then you can review it. If you like everything, you can sign digitally right there through the portal. Once we approve your investment, you can then fund it by transferring money through either an ACH transfer or a wire transfer. And then that's it. You can sit back, relax, and enjoy your passive income if that's the election you chose, or let your money compound. Thank you for watching, and we look forward to working with you.